Welcome back. Here's our example of the net present value method. Alright, so with this we're trying to decide whether or not to buy a certain piece of a new equipment. So the cost of the new equipment is $200,000. We expect it to last us for 5 years. Our desired rate of return. So what we're saying is we need to we expect to get a return on this item that we're buying of 10%. And we'll get into that in a second. The expected cash flows. How much is this machine going to earn us? And as you can see, it's different each year. It's $70,000. This machine is going to of income. This machine is going to bring in for us. In the first year, $60,000. The second year, $50,000 and $40,000 and $40,000. In total, the total amount of cash flows is $260,000. Now, the idea here is that we have to lay out $200,000 today, right now. So, if we start looking at the time value of money, how much is this money really worth? This $40,000 that we're going to get in year 5. What is that worth today? So we're going to look at these cash flows and decide whether or not it makes sense to lay out this $200,000 today in comparison to the present value of all of these cash flows. So I'm going to go right to the graphic, and then I'll come back to the calculation in a second. The idea is, like I said, I have to lay out $200,000 today. Well, what is this $70,000 a year from now worth to me today if I bring it back to today's date? So $70,000 I was earning in year 1 if I were to go to the calculation tables of the present value of 1. And you have to use the present value of 1 for each one of these. The reason being is because the amounts were different. If these amounts were all exactly the same, then you could use the present value of the annuity tables, but they're not. So the idea is we're saying, okay, what is $70,000 on December 31st worth to us today, 2012, 1 year out? Well, $70,000 is worth $63,000 to us in today's dollars. Well, all right, December 31st, 2013, $60,000. What's that worth to me? Well, in today's dollars, which is January 1st, 2012, that $60,000 is worth to me $49,000. Okay, and you do this for each one of these. And you get all the way down to December 2016, and you say, all right, well, this $40,000 that I'm going to receive at the end of 1, 2, 3, 4, 5 years is worth to me today, in today's dollars, $24,840. So if you added all of these guys up, and I don't have the total here on this slide, if you added all of these guys up and it's less than $200,000, which is the initial outlay of the cost today, then you should proceed with the project. Okay, so going back to the calculations here, they give you the present value of 1 numbers here. 10% is the desired rate of return is 10%. That's how much money we expect to return on anything, on any of our investments. So we're using 10% as our calculating number here as our percentage. So we've got year 1, and we went to the present value table for 1 at 10%, and 2 at 10%, and 3 at 10%, and so on. And what that came out to be in total, the total cash flow, not considering the time value of money, is $260,000. But when you do consider the time value of money, the total cash flow of the item we're buying is $202,900. The amount of money that we intend to invest by the outlay of cash, if you will, is $200,000. In total, the net present value is $2,900. It is worth it to us to have this piece of equipment. We're earning the 10% rate of return that we expect to earn on our investments, and we are getting more money at the end of the day from considering time value, the present value, you're getting more money than you're outlaying. You're going to be earning $202,900 from this equipment, or you're estimating that that's what you'll earn, versus the $200,000 of cash that you pay out in order to buy the equipment. And this slide summarizes all nicely. The net present value of $2,900 indicates that the purchase of the new equipment is expected to recover the investment, pay for the investment, and provide more than the minimum rate of 10% rate of return. So this would be something we would buy. Now remember, the net present value method is the most popular one based on that grid that we had earlier. What we could do is if we were trying to decide between multiple capital investment proposals, we could rank those proposals by using what's called a present value index. And it's computed as it shows here. Total present value of the net cash flows, right, over the amount to be invested. Gives you an index. Alright, so using our numbers before, the present value of net cash flows was $202,900, and the amount to be invested was $200,000. And if this amount is more than one, then you're okay in the sense of that you're ahead of the game here. Alright, so if you're ranking proposals, you're trying to decide which item to buy. And let's see, you had proposal A, proposal B, and proposal C. And you're ranking, these numbers are different than the numbers we were using before, but you're ranking them, you're using the present value of the net cash flow over the amount to be invested. Present value of the cash flow is the amount to be invested. Same thing here. You would look at the three of these and say, well, which one is going to give me a better present value index or return on my money? Well, just looking at these numbers without the indices, you'd say, okay, well, proposal A gives me 7,000 and proposal B gives me 6,400. But you're spending more money on proposal A than you're spending on proposal B. So how do you decide which one of these to go with? And proposal C, it actually winds up being that the present value of the net cash flow is actually negative in the sense of you're putting out more money than you ever expect to return from the purchase of this item. I know it's cut off a little bit on the side, I'm sorry about that, but it is less than 1, so you wouldn't be interested in proposal C. But looking at these before, as I said, it looks like proposal A is better, you're getting more money out of the deal, but in reality proposal B is better. You're getting a better return on your investment. Okay, the internal rate of return method is very similar conceptually to the net present value method. The idea here, though, is you're almost working backwards in order to come up with the whether or not the determination on a proposal. So with this, well, let's just go into this. I'll show you how this works. All right, so you're going to start off, you're saying the amount to be invested in the asset over the equal annual net cash flows. All right, so you're expecting to earn $20,000 a year from whatever this asset is that we're buying here, and the amount to be invested is $97,360. That comes out with an amount of 4.868. Now we're looking at the annuity tables here because we're saying each year this asset that we're buying or this investment that we're making is going to earn $20,000. Okay, so if it's the same amount every year, we can use the annuity tables. So you can see that this amount comes out with 4.868, amount to be invested over equal net cash flows. Now what we don't have here, if you notice, is the acceptable rate of return. Right? Before we said that you had to have at least a 10% rate of return on the other problem, and that was part of the calculation that we looked at there in order to look at the table. Well, in this case, like I said, we're almost going to look backwards. What we're going to do is we're going to go directly to the annuity table. And we're going to find the number that was closest to that number we came up with, 4.868. Miraculously, it works out exactly to 7 years at 10%. All right. Something they didn't tell us is the 7% is 7 years is the time frame that we're looking at here for this asset. Okay, that information was not given to us here. All right. So, like I said, the 7 years part of it isn't being given to you, but what you'd be looking at here is the 4.868. You would go to the 7-year mark and you'd look along it and you'd say, okay, what's closest to the 4.868? As I said, miraculously, it's on this 10% line. And if it was on the 10% line or the 11% line or the 12% line or 13% line, then you would choose this asset because your internal rate of return that you expect to have on your investments is 10% in this problem as well. So, oops, there you go. The minimum acceptable rate of return is 10%. So really what it is you come up with the annuity factor, and then you find where it falls on the table. And if it falls into, if your acceptable rate of return for a business is 10%, if it falls anywhere in the 10% or higher category, then it's an asset that you're interested in investing with. Right? This one's a little bit more backward, a little bit less easy to calculate than the net present value method. The net present value method is a little bit easier to get your head around, but ultimately they do come up with the same results. Alright, to finish this up, there are a few items that are not being considered when we're looking at capital investment analysis, at least not in the ones we've done, but they are items that do need to be considered. Things we haven't talked about at all is income tax. So if we're talking about buying a piece of equipment for $200,000 but you're paying 6% income tax on it, well then your number changes entirely. You know, it's $200,000 at 6%, and then your calculations as to whether or not it makes sense to buy the asset or to invest in the item that you're purchasing could change dramatically. You could have proposals that have unequal lives. Maybe one item will be good for 2 years and the other one will be good for 10 years, but you're trying to compare them with one another. Maybe leasing rather than purchasing is a way to go. Any sort of uncertainty in your business, changes in price level, qualitative factors. Qualitative are things like customer service, loyalty, things of that nature. Okay, so there are other factors that, but if we're deciding whether or not we're going to put our money somewhere to invest in a purchase, you would have other things to consider other than the simple calculations that we did here today. Okay, that's it for this chapter. Hope you enjoyed it.